Hey YouTube, this is Zach with Achilles Financial. Today I want to talk to you about how you can take some gains on some of these stocks that are having huge down days without buying the actual stock. So in particular today I'm going to be looking at STPK, we're going to be looking at NIO, and then for a little bit more expensive play I'll bring up Tesla as well. The strategy I want to talk about today is selling cash secured puts. So oftentimes you'll hear me talk about selling covered calls, which is arguably my favorite option strategy of all time. Today I want to showcase Thinkorswim, the web version's capability to showcase the profit and loss as well as the potential awesomeness that can come from cash secured puts. Keep in mind that options trading is incredibly risky and that I am not a financial advisor. I'm just some guy on YouTube, so make sure you're doing your own due diligence. One of the things that I like about option strategy trading is the fact that I genuinely do like the stocks and I like to be paid a premium when I am making a trade. So without further ado, let's dive right in. Keep in mind that the stocks that we're going to be looking at today are just some of the ones that I am personally following. I have a huge holding in STPK, like 80% of my trading portfolio is currently in them, so I am biased on some of these stocks. You can see that if we go to the 3-day view of STPK, we're coming down from their all-time highs where they traded up over $50 a share for a little bit, and then we've had some big down days. Most of that downward momentum is coming overnight gap downs followed by some nice raises. Again, they're pretty much following the broader market. SPY's been doing the same thing. What we have the capability of doing using the options functionality in Thinkorswim Web is, as you can see right here, you have the capability to track what you anticipate or what the proceeds of holding that option until expiration will be. We're not going to be looking at the call option I have already placed in here. Rather, what you'll do is you'll go into option trade, you'll click on sell, you'll click on put, and you can now see that you have an option readily available. What a put option is, generally speaking, if you are buying a put, you think that the stock will go down, or you currently have shares of that stock and you would like to hedge that position. So for an example here, if you were to hedge a position, you could potentially have 100 shares of Star Peak Energy that you had purchased at 100, or we'll call it $15 a share. So your $1,500 investment is now worth, at the current price of $42, $4,250. So what you may say is, hey, I would like to sell a put for April 16th for $40 a share. That would cost you $760. However, it would lock in your gains because your shares would sell at $40. So if the price were to drop down to $25, you would still walk away with a lot of that gain that you had from your initial purchase at $50 a share or $15 a share. What I'm looking to do here is actually to sell the put option. So for example, if we are looking at March 19th, the reason I would sell a put option is because in this particular example, I want to buy the stock for a certain price, and I think that the stock is going to go up. So right now the share price is $42 a share. If I said that I would buy this for $55 a share, that means for me, I would have to have $5,500 of collateral to sell this put option. You can see that right here, the review. It would showcase the cost, so you would be paid $1,500. We'll make that $1,570. However, you would have to hold $5,500 in credit. Again, that's the $55 multiplied by 100. However, if I say, hey, I think that the stock price is going to go up from this level, so I think that the stock is going to go higher than my break-even point, which under this option trade that we were just looking at of selling the put for 55, for this option trade, for me to win here, the stock price has to be higher than $39.32. So if they had a big run and the stock price went to $50 a share, I've already been paid that $1,500. So despite the fact that I have to pay $5,500, I'm currently sitting on $1,570 of cash that I was already given. So that means that for me to lose, the stock price has to go underneath that value of $39.39. So right now we're seeing some huge dips, but if I say, hey, I already like this stock and I want to hold it long term, I'm willing to purchase it at these prices. So what this can look like, again, if you go all the way up into some of these higher realms, for $6,500, you'll see that you get the option to be at a similar price level here, right at $40.40, where someone will give you the cash to kind of cover the difference between those two positions. So yes, I am having to pay or keep in reserve $6,500 that I can't touch till March 19th. But if the stock goes over $65 a share, I don't buy those shares, but I still walk away with $2,450, which in this particular trade is right at a 35% return on investment over the course of 2 weeks. Now, that being said, the stock price could also drop to $35 a share or even $30 a share, and I'm still having to purchase those shares at $65 a share. You can see in this example here that does end up costing you $1,032 if it drops down to that level. The reason why I like this is because I'm naturally bullish on a lot of these stocks, and for the capability to take some huge gains here, I mean, you have the capability to basically get paid to buy stocks you want to own long term anyway. It just depends on the price. If you say, hey, Zach, I don't know how I feel about that, you can actually go all the way out to December 17th, and this is a pretty safe way to capture pretty long-term gains, because as you can see, the stock price here in this example would have to go all the way down to $27 a share for you to lose out on this trade. Again, you still put up $65 of collateral, but you're getting paid $38 a share or $3,800 for you to accept this trade. The reason why I like this is because at any point in time, they may say, hey, I'm going to take my loss and exercise this and sell you their 100 shares, so you have to pay. But as long as it's not under this mark right here, you're still a win in that particular boat. The key idea here is, again, that it'll keep rising and rising, and you can walk away with $3,800 with this exact same trade. So if we're talking about doing this for some other stocks, this momentum is huge. Again, you want to sell these when they're going down. NIO is a stock that I know a lot of people who watch these videos would like to own. They also have a lot of options available. So for just the end of this week, STPK doesn't necessarily have that many. If you've already been purchasing at $60 a share, why not take $950 to purchase these? I mean, this again, you can see is the stock is a little bit more bullish in nature. People have this expectation, but you can collect $1,000 to basically buy at the $50 price it's at right now. So they're basically charging these at the money options right now. What I would be looking at though is why not just collect some of that money today? If the stock is back over there, you walk away with $1,200, or as you can see right here, you have the capability to basically break even, or if the stock doesn't go any lower and it does end up at $50 a share, you pocket $340. This is a great way to utilize cash that is sitting on hand. Now, these are in the money put options. What you also have the capability of doing is going down below the money. So if you think, hey, they're going to drop even further, you could hold the option at $40 a share and just collect the $188 that you see represented here. So what this would look like is you have to hold $40 in collateral. However, if the stock does not move below you'd have to hold $4,000 in collateral. If the stock does not move below $40 a share, you get to keep the $188, no harm, no foul. So this is a great way to make passive income by just selling the puts and utilizing the cash that you may have sitting on the side. One of the things I really like about this strategy is if you do have the cash and the capability to make some moves on some of these stocks that are having huge down days, you can see that Tesla has been having quite the day or even quite the week. If we go this out to a weekly chart, you can see that they've had quite some time over the past few weeks. So how can this strategy work? Again, this is something that I personally can't trade because it's outside of my repertoire and financial commitments. But if you look at some puts for like the end of March, so if you say, hey, I like Tesla long term, well, depending on what you think the stock is going to be, someone will pay you right at $5,000 to buy the stock at $700 a share. So if I'm selling that put, that means I'll get $5,000 right here, $4,950. We'll make it 50.53 or 50.35. As long as the stock is over $650, you're set. Your worst case scenario here is you do have to buy 100 shares of Tesla. And keep in mind, though, that for this $700, you do have to have $70,000 in collateral. So let's talk about this kind of for some of the longer term. If you go all the way out to December, it's now $17,000. So you can get nearly $18,000 right here off just holding $70,000 in collateral right now. The reason that that's so important is because this is a relatively safe way to make a lot of money on stocks that you would actually like to have, especially if you're willing to own them at a certain price. But I mean, if you think of if you can capture $18,000 on a 17 or a $70,000 investment every single year, then you're walking away with a 25% return annually. And your worst case scenario is you have to own the Tesla shares. Worst case scenario, if you buy the shares, is you then start doing covered call options. And so if I had to purchase this, I'd still be okay. So at any point in time, you'd have the capability to purchase that and you'd be set. On the reverse side, you could then go and you could just sell the call for $800 and I can get $15,000. So the options here are really limitless. There's a lot of capabilities you can do with selling those cash secured puts and taking advantage of those options premiums, especially when we have these big down days like 8%, where you can take advantage of those premiums. So this is just another option strategy to add to your repertoire. Check it out. I'm a big fan. Oftentimes I prefer to just buy the shares, but this is a capability to be forced to buy the shares and get paid a little bit of a premium to do so. So if you found this content helpful, please leave a like and subscribe. If you have any questions, drop them down below, and I will talk to you all later.